For those of you that don't know me, I'm Anthony Baker, so I'm the Senior Investment Director here at Claret, and we're going to be talking a little bit about the journey of entrepreneur turned investor. And for this, I'm delighted to be joined on stage by Richard Muirhead and Mons Holtzman. So gents, thank you very much for joining us. Before we kick off, I'd be very grateful if you could briefly introduce yourselves to the crowd.
Well, to start, I have a background, I've been in the IT industry since 45 years now, so I came in the beginning of the 80s. My claim to fame, if there is any fame, is that I was the CEO and chairman of a company called Click for 10 years. And during that time, we grew it reasonably fast and became one of the dominant BI players in the world. Since then, I've spent the last 15 years investing and advising companies.
So, my name is Richard Muirhead. I'm managing partner at Fabric, as it says up there, I think. I can't believe that you were talking about the early 80s. He doesn't look that old. But I encountered Click when I was being an entrepreneur in residence with Accel Partners back in the early noughties. So we crossed paths then, and we actually ultimately crossed paths again in kind of working on accelerating an investment we both went into called Atomic. It was fun and successful. I would describe myself as a kind of an engineer who didn't quite have the ability to sit down and focus on coding for long enough to do anything meaningful, who totally fell in love with the power of software and built a piece of sort of telecoms middleware that is still supporting a big chunk of Oracle's business today in that telecom space, and then built another piece of kind of middleware that supports a big piece of BMC's sort of cloud management business. And then my kind of third act has been building Fabric, where we try to intersect with really daring founders at the very, very earliest stages, literally kind of possibly even pre-deck, but all the way through to kind of early Series A, and work with them on their adventure and try to help them rather than mess it up, and both are possible, and maybe we're going to go into that.
Great, thank you. Well, look, given the topic, we'd do incredibly well to cover everything from entrepreneur all the way through exit, and then on to investor in the half an hour or so we have, but we're going to give it a go. So if we scroll all the way back to the beginning, and Richard, coming to you first, what was it that made you want to be an entrepreneur in the first place?
So I actually wanted to kind of continue studying at Cambridge and continue rowing, because that was a sort of beautifully romantic life. But I stumbled out and I started working in strategy consulting. And I soon discovered that being in a sort of services business where you were a cog in that machine was definitely not for me. I wanted much more agency. I remember specifically actually I was working a lot on the kind of the former Soviet Union countries, looking at seeing if there were opportunities to repurpose some of the businesses there. And we were working with a pharmaceutical company, and I can leave out the specific names, but a big German one, and we'd done this deep analysis on this factory we could acquire and why it was a good idea or not a good idea, and we'd calculated the NPV of the deal and whatever. And we reviewed it with the client, and the client said, well, actually, I want the NPV number to be this, not that, as in it needs to be positive to show that this is a good idea and not negative. And I need a slide with a sword in it that shows that there's going to be these taxes and tariffs coming in, and therefore we need topical, obviously, and we need to take action now. And that, for me, and actually it just occurred to me right now, but that kind of characterized the frustration of why do all of this work when actually what it comes down to is serving the kind of client's narrative. Not that that's necessarily wrong. So that was what I think propelled me into being an entrepreneur.
And I've been there before Claret, obviously. And Mons, how similar was that for you? Because I think you're an investor in Click, the company you mentioned before you then became CEO. But what was it that made you want to take on that role?
I think in my case, I was born to be an entrepreneur, really. And my main driver when I was a kid was that my weekly allowance wasn't big enough. So I wanted to make more money, basically. So I got my first job when I was 11. And then that story kind of continues. So I started my first business when I was 17. I joined my first startup when I was 24. I joined my first board when I was 25. I did my first management buyout of a company of some significance when I was 31 years old. So and as I said, my main driver was that I wanted to make enough money to become financially independent. Put it as simple as that. But I always had this kind of curiosity, and I was interested in figuring out how people work and how you can use that knowledge to tailor business models and what have you. So I came in, as I said, I came into ClickTech as an investor originally. We were pretty successful in the management buyout that I did in the beginning of the 90s. So at the end of the 90s, we were sitting on a holding company with some money and some other assets. And we decided to invest in companies. I came into Click. I found ClickTech. Believe it or not, this was the first company I looked at, which is unbelievable. Joined as a board member in January 2000, and after only a couple of months, we realized we had to change the CEO. And I happened to be in the room when we discussed it, and that's how I became the CEO, because I was the only one who could make myself available. So that's the simple story. And I loved it. Yeah. It was the professional adventure of my life.
And actually, that's just one of the stories you have. And I think if you go through your whole tenure as CEO, there's lots of very interesting things, and encourage you to speak to Måns and also Richard about their stories. And we'll revisit a little bit some of the learnings you got from that period. But I want to fast forward all the way to the very end of your time as CEO, because when you and I have spoken before, you have mentioned there was a sort of very specific moment where you knew that your time running the company was over. Maybe tell the audience a little bit about that time.
Yeah, and that goes back to the sort of the love for the entrepreneurial spirit, because I realized when I was fairly young, having worked in both small companies and large companies, that I'm most comfortable in small companies. And unavoidably, when a company becomes large, you get more layers in the organization, you have to be more process-oriented, you have to have more rules, you have to have more hierarchies, and so on and so forth. And that's okay if you're on the top of it, but in the middle there will be lots of politics and people trying to maneuver and stuff like that. We try to defend that, but I think it's inevitable. So I always knew that I was building a company where I eventually wouldn't be comfortable myself. So I sort of had an exit plan very early on. And I also knew that I didn't want to be a CEO of a public company in the US, because there's a lot of downsides to that. And me and my wife had decided we wanted to stay in Sweden and so on and so forth. So I sort of knew that I had to transition well ahead of the IPO. But the specific time that you're mentioning is that there was a board meeting, and I think if I go back to my notes, I can probably date when it happened. When before that board meeting, we always wrote the minutes on one sheet of paper, but you could actually understand what we had decided and what we discussed. And when we decided to go for the IPO, all of a sudden the board minutes were written by a lawyer. They were 7 pages long, and no one could understand what we had discussed, which was obviously the purpose of the exercise. We went from discussing markets, organization, culture, values, sales, geographies, customers, products, and so on, to discussing banking syndicates, compliance, advisors, what have you. And then I realized my time was over.
Oh, very good. And you talked about an IPO, so let's move on to exit. So a fundamental part of the journey for any entrepreneur. And Richard, you're in the very rare breed of entrepreneur or founder or co-founder that's had more than one exit. And so you would have seen all the things that people can do right and all the things that people do wrong in those situations. What was it like in the run-up, if we go back to your first business, in the run-up to that exit process? And is there anything you would have changed before or after the exit?
Yes. I think I can start by sort of saying, and in response a little bit to what Måns was talking about, that, you know, I gave the sort of anecdote of being frustrated with consulting, but to be totally fair, I only really ever treated that as a kind of an on-the-job MBA. We were moonlighting, building a company pretty quickly, and really another thing that drove me in the entrepreneurial direction, and this I think will relate directly to your question, was just falling in love, as I sort of mentioned, with the power of software and with the whole hustle of trying to, you know, move very rapidly through small iterations to crack the code on building a new product and building a new go-to-market, until such point at which the flywheel takes off. Someone said to me when I was lots of things while I was sort of incubated at Axel Partners, obviously a very storied venture capital firm back in, you know, early noughties, about, you know, trying to work out what is your point of differentiation with the product and getting it just right so it becomes so compelling for people to buy it, and how do you encapsulate and market that, and then trying to work out how to crack the code on the sales engine so that it just, you know, it just whirs, and that over time you want to be doing stuff that is just do the work so it gets easier over time. That's what, you know, whether it's sort of getting up on your hydrofoil, if it's a metaphor or whatever, that's what you're seeking to have happen. And that's you know, it's such a beautiful thing when it takes off. You become addicted to that process of trying to make that work. And I think that's the thing that drew me in. And, you know, Måns, you mentioned that you had, and you know, financial independence, I guess we kind of all would be comfortable having, you know, wherever you are in that journey. I definitely, on this exit point, have found it interesting in that I believe you almost have to be a little bit schizophrenic, sort of purposefully schizophrenic, to navigate exits. And what do I mean by that? I mean that whether you take the IPO that we did in June 2000, we went up to kind of $1.4 billion market cap, and there were opportunities to sell stock at the listing, and it was 13 times oversubscribed, and then, you know, lots of things happened. Or another opportunity, I had to sell my second company just before the great financial crisis. It was only like 120 million, the second one. But I was in love with the product and the team and what we were building together and how to get up on that hydrofoil. That was what you were obsessed about every day. And trying to suddenly step back and go, you know, it's enough, there's a price, and not feel disloyal in some strange way to your teammates who brought on board and to your customers and to the whole engineering endeavor, I found at least more than once extremely hard. And therefore, rather than feel guilty about that, I think actually I have coached several times actually with founders I work with that you have to try and, you know, be more dispassionate and sit back because it may well be the right time to sell. And you can't just like, well, if it happens, it happens. It doesn't, because often there's a lot of activity that's required to make that happen, or clear decisions. So that I definitely try and put it this way: I pass on as coaching to the teams that we work with.
Got it. And then you touched on the second business, so you did it all again after the first IPO, and you mentioned a little bit about timing. And so just to draw on that one a little bit more, what were the ups and downs as you went through that exit process? And what did that kind of teach you about the art of timing the exit?
The second one? Yeah, so there is definitely a little anecdote in that, and that we had built a business, we'd reached about 20 million in revenue. It was under the pre-financial crisis. We were looking to raise a Series C, and we ran a sort of dual track on that. And this goes back to this point of trying to be purposeful about creating those options for exit at that time. And through that process, we had multiple interested parties, and Oracle had the 120 million sort of price tag that they wanted to kind of offer. And I can remember pacing around, sort of agreeing the final sort of details of the deal during sort of August. And then we came back, and the due diligence team had been on site, and this guy called Ali Siddiqui was there, and I had a breakfast sort of brief debriefing with him, and I was like, so how did it go? And he's going like, literally sort of double thumbs up, so much better than I imagined. That's just fantastic. And of course I'm going, yes, result. And he leaves, he goes back to California, crickets, tumbleweed, no response. Bankers are sort of just tweaking generally. About 6 days later, contacts back and goes, yeah, we've canned the entire acquisition program. There was a kind of war chest of about 500 million. We're not doing it. And it was such a sort of switch. I was like somewhat devastated. Then what happened is the whole subprime debt and CDO issues arose, and everything went to hell in a handbasket. And we'd planned on some venture debt alongside an equity raise, but we hadn't actually locked in the venture debt when we locked in the equity. And then clients stopped sending their orders in, and we went from a $9 million forecast of bookings in one quarter to like one, overnight. That didn't feel great, and I spent 2 years getting to the final exit, working extremely hard to kind of make that happen. And in the end, I ended up not selling to VMware, but the guy left Oracle, went to VMware, and he told me the story. And he said Larry Ellison had been playing tennis with Mark Hurd, and Mark at the time was at HP and Larry was at Oracle, and Mark didn't want Larry bidding on something. So he asked Larry asked Mark not to bid on something, and vice versa. And so that was how the 500 million ended up kind of unraveling over a game of tennis. And no one in the team understood it to any greater depth than that. And the lesson was, stuff can happen out of left field. Timing of markets and macro stuff is just those waves on that sea are way more powerful than your ability to steer the boat, row the boat, And so be purposeful about those exit opportunities, even if you're in love with your product and your team and so forth.
And look, there's so many interesting bits to pick up on there. We're going to switch to you now, Mons, because you also had an exit as well. And for people that don't know, it's widely regarded as a hugely successful one with Click. I think one of the first unicorns in Europe and one of the best returners of any European-backed venture business in history. But sometimes when you talk about it, you mention this $1 billion mistake. So what was the mistake, and how much did it really cost?
Well, we laughed about it many times afterwards, but there was a couple of mistakes that we made that were, I refer to as the $1 billion mistakes. And the first one was very early on that I was trying to persuade the board, and I was a very cautious board, very, very Swedish in a very conservative way, so not good. And I wanted to hire 2 more sales guys, and they wouldn't let me do that because they didn't think we had enough money, and they didn't think that we could make those sales guys productive fast enough. But with the momentum, you have to, probably people don't know the story, but due to new technology in the BI space, we actually opened up a white space that we had to ourselves. So very much of the success of ClickTech was to execute fast enough. And we managed to create momentum on the market. So very much of the success was based on our own ability to build the organization fast enough and to make people productive. That's it. And if we had been able to hire 2 more sales guys, I'm convinced that instead of the $150 million that we did at the time of the IPO, would have been at least 250 million. And you can imagine what that would have done to the $1 billion valuation that we had at the time of the IPO. So that was, we can argue if that was a $1 billion mistake or not, but it was, big money. The other mistake we did, we were actually, when we started, the incumbent model was perpetual license. So we started selling perpetual licenses. But with the same board, we discussed moving to a subscription model very early. And again, you have to bear in mind that this was the early days of Salesforce. Salesforce hadn't broken through really at that time, so the SaaS and the cloud model hasn't really risen at that time. So of course it wasn't so obvious, but still we discussed moving to subscriptions because we sort of realized what power it had. Of course, it would be a little negative on the cash flow in the beginning, but over time it would be amazing. So, but they wouldn't let us do that either. And again, if we set aside the 2 sales guys, but if we had been a subscription model at the time of the IPO, I'm pretty sure that was a $2 billion mistake, at least. I don't know what how you will value that, but...
Yeah, I mean, it's hard to value, but I totally agree that subscriptions turned out to be kind of the way to go.
Exactly.
I also attempted my own sort of switch midway through building the second company, and actually looked at it in a third company I invested in and helped scale, the one that we looked at it at Atomic together. And when you've already started, it can be hard to reorganize the whole organization around that, and indeed the way the software works. But it's become a very compelling business model.
Yeah.
I guess
it's easier when it's small.
It's easier when it's small, but it's an interesting question. Like subscription, SaaS, maybe it's come up today. I don't know. There's obviously a pretty active debate as to what is the business model and delivery model going to look like for software going forward. And I confess I was in Berlin coming back, and I caught the tail end of the last session. But at least for our part at Fabric, we see a total inversion that might happen. So that we're not even moving to a situation where, whether you're a consumer or an enterprise, you might go, I've got a problem. Oh, is there an app for that? I can download the app and we're good. We're not even going from that to, oh, I've got a problem. Is there an agent for that? Let me download the agent or access it. It's not going to be like that. What's going to happen, we believe, is that you will go through life and you will be either consciously or somewhat unwittingly sort of, with your permission, hopefully, or maybe not, we'll come into that, creating personal data property, data exhaust, intellectual property that will be observed by AI-driven systems who will then have delegated authority to come and deliver the right things to you proactively. So, and possibly through kind of ambient computing from love from, and through all the devices and the wearables that surround us now. So it's like, for us, it's a new business model, an inversion of the way the whole thing works, the death of the app store as well as the death of apps, and new devices, embodied AI, wearables. I think we're going to go through what we call like a triple platform shift over this coming period, which is pretty exciting. Who cracks that code now? As SaaS does whatever it's going to do, hopefully not die overnight. That could be a bit disruptive to people. But these new delivery models and these new business models, I think it's 10 times bigger than SaaS ever was.
Fascinating. And look, let's move on a little bit now. So we've done entrepreneur, we've done exit. Why did both of you want to become an investor?
Did I?
I was an investor, so...
Yeah. So after the second exit, after 2 years after the financial crisis, actually I got sort of tapped on the shoulder by Kevin Kamali at Accel Partners saying, you might make a really good investor at Accel. And so And so I got into that conversation, but that didn't end up finally consummating. Like, and there are only so many seats at the table. Like, and we didn't end up joining the team, although I remained very close, with Axel. And that sort of whet my appetite for what the potential was. And I was emotionally tied to, as I said, this sort of addiction, this love for kind of company building and product building and team building. And I felt very sad possibly about the idea of kind of hanging out my proverbial boots and transitioning from kind of being, player to coach. But having sort of looked inside what happened at Axel a little bit, and I had earlier when I was in entrepreneur residence there, I realized a couple of things. First of all, I could build a firm, my own firm, and therefore I could still flex those kind of company building desires. But also, this was back in 2009, 10, 11, 12, when this was kind of coming together. The venture capital community has come a huge distance since then, let alone since I took angel investment from Esther Dyson and Herman Hauser in the mid-90s. And I think I saw at that point in time, and I believe this is still the case just to some considerable degree, basically a huge gap that I want a problem to go and solve, which is, sophisticated, passionate, long-term, patient investors with the technical and sector-specific chops to have productive, high-bandwidth conversations with founders as they pull their team together and as they scale the businesses. We still need more of that, and who are armed with capital who they can put to work. And I saw that then. I think we've come a long way. New firms like Local Globe and Passion was just kicking off, and Entrepreneur First and whatever, and hopefully Fabric is doing its bit within what we call kind of the open web. But I still think we've got a long way to go. And whenever I hear somebody say, government or treasury or some pundit say, we've got enough, firms or whatever, at every stage, I think we could do with more and better to help build the ecosystem. And it has just never been more important than it is now to have, homegrown innovation that stays homegrown and hopefully can be acquired locally and can list on local exchanges and can, be there to deliver technologies we might need, not necessarily just weapons, but that's obviously a whole topic, but other critical technologies, just AI models, for example, that I believe need to be distributed in a balanced way around the planet for us to avoid falling into the traps humanity occasionally does.
And Mons, was it just you wanted to go back, or was the other
becoming
reasons?
an investor?
To be an investor, yeah.
I think if you, when you make an exit of the size that we did, you become an investor whether you like it or not. The question is rather what do you want to invest in. So, and in my case, I wanted to set aside money for my family, basically to provide for this generation and next generation and so on. So, and provide that sort of security. But then, above that, if you make, I don't want to sound arrogant, but when you make enough money, then the value of another dollar isn't that high anymore. So my driving force, it's long since my driving force was to make more money. I don't need to make more money, and of course, what I do is I do make more money. So you could argue that I do that because I want more money, but it doesn't mean that much. But the main reason I do it is because I want to do a good job. And so I started investing in private companies first as a way of just staying in the business, I think for the same reasons as you outlined. So I think there's a sense of giving back and trying to do something good. I genuinely think that these young, innovative companies do something extremely good for society. So in the beginning, it was just that. But then over time, I think I have refined my investment thesis a little. So I'm trying to involve myself in companies, and nowadays also quite a lot of funds, where the money and the skills that I represent have as high impact as possible in a good way.
Reminds me we need to get you into my fund, actually, but we can talk about that.
We can have a discussion
Or we
about
can
that.
close the deal now.
But what I mean by that, when you engage yourself in very, very young companies, it's nice, but if that's the only thing you do, the impact is fairly tiny. Because, I mean, if you engage yourself in a company that has 5 employees, and then you work with them for maybe 4 years, I mean, after those 4 years, maybe they are 20 or they're 50, but the impact isn't that big. But if you involve yourself in a bigger company and you can advise that company and you can help it grow faster and in a more secure way, then they might go from 100 to 1,000, from 1,000 to 3,000, and so on. That has a much, much bigger impact to society.
And what's the transition actually like from entrepreneur to partner in investment fund? What are the big similarities? What are the big differences in the roles?
I think the similarities are, I mean, you're trying to find opportunities. When I've involved myself operationally in something, it's always, I'm always breathtaken by it. I see something and I'm always breathtaken by it. So, and I describe it as getting tunnel vision. So, and for some funny reason, I've been exposed to opportunities several times in my life, and I just know they're going to be good. And I've been right 100% of the times. So, and then I've done investments, other investments where I haven't been involved operationally, who have failed. So I'm not a genius like that. But I think I have this ability to see things and sort of intuitively understand the uniqueness and the opportunity. And I think I have this ability to see a path forward. It's kind of scary sometimes because it's almost like I can see into the future. I have that. And of course that's a skill that comes in handy when you're an investor. But then there are differences too, and the main I think you were touching on it before. You go from being a player to a coach, I think you said, and there's a big difference between being a player and a coach.
Yeah, so I remember having this discussion with myself or other people when I was contemplating the jump, and I think at the end of it, you actually ultimately you end up with having different types of investor board members, and we'll come to that in a sec. And there's not necessarily a right or wrong way of doing it, but there are different. But in making the jump, I thought about it hard. I was like, well, Ben Verveyen, who ran British Telecom at one point, said to me that, you know, if you've got a team of great executives working with you, your job is to treat each of them as a kind of prima donna ballerina. Like, you know, to get the absolute best out of each of them, and really, as much as possible, as kind of the chief executive, to kind of get out of the way. And it reminds me of another saying, which is, if you're going to build an effective organization, you should strive basically every day to make yourself sort of utterly replaceable, or like, if you took your hand out of the organization, that would, you wouldn't disturb it. And that ironically, by doing that, you actually make yourself irreplaceable because you're supporting everybody else so kind of harmoniously. So I thought about then, well, if that's what I'm aspiring to do as a chief executive, founder, CEO, how different is that from being on a bunch of different boards and working with those founders and helping them be, whatever, at the Royal Opera House and performing their finest dance, and it's, I think in some senses it's kind of very, very similar. There is one difference that I found that I think necessarily when you're company building as a CEO, you get pretty good knowledge of all of the different disciplines, marketing, sales, product, whatever. When you're then investing in a lot of companies, and I find this frustrating sometimes, but it's inevitable, you can never be as deep as the team in their particular space. So you have to accept that they're going to be much deeper in a particular domain and in the company than you are. So you have to expect and respect that, the way you operate with them. Nonetheless, bring to my kind of first point and wrapping up, there are two different types of board members who are investors. And I think, we'd probably, and you were talking about being able to see the future, or I was saying to some people on my team, like, you need to be able to see around corners a little bit. There are those who can do that and work very tightly with the founding team and will, in a sense, whatever it takes to make this successful, I will do. This isn't like, I'm not here for kind of giving you oversight and checking, ensuring the audit committee's done this and whatever. I'm here to make sure that I do whatever's necessary with you to make this successful. And then you have board members who are a little bit more like, well, you're the kind of entrepreneur, and like, I'll kind of see whether the process looked like it was a good process in recruitment or a good process in, setting the budget or something like that. But I'm a little bit arm's length. Now, I think they can both work well in different situations depending on the aptitude, and it brings us a little bit in the venture space to the debate. Are the best investors in venture ones who have operating experience, or or can you be a journalist like Mike Moritz from Sequoia and kind of do it brilliantly? And I think the answer is very clear, obviously. No, it depends obviously on lots of different situations. It's more about the discussion and the debate, I think. But most importantly, take the approach that matches your capabilities and do that well. Like most things, like pick a strategy and do a whole bunch of things that supports that strategy super well. That also applies as a venture investor, I think.
I think you also have to find your ways of coaching. If you want to be a good coach, you need to find the ways to coach management in a way that makes sense. And we were discussing it, Ralph and I, before, that the boardroom isn't a very good place to coach.
100%. I mean, building on your point, I remember actually, I briefly actually ran the investment we scaled together just before you actually came on at Atomic, and I just remember into that coaching question. I remember a mistake I made where your relationships with your executives, can be incredibly unforgiving. I had actually a really good relationship with one department and one individual, but I remember I was very frustrated with the lack of delivery in a particular area, and I'm keeping it neutral just in case and I still have respect for the team and the person, but I got very frustrated and I allowed that to emerge in a conversation. It wasn't the board conversation, it was kind of the team conversation. And in spite of everything else, I think, going extremely well in that whole relationship, that one thing created a rock the boat, a disharmony that really was not helpful at all. Yeah. And I'm acknowledging, I think, but it was that one small slip of getting a bit frustrated and expressing that disappointment was a problem in terms of management. That's how. If
it's just one, then you're much better than I am.
Well, I'm sure there are more. I'm just commenting on how big the impact of that one was. Yeah.
Look, thank you. I have one last question just to try and bring it all together. And if you both look back upon your time as entrepreneur, what would each of you say is the one key learning that you take from that time that you apply now today and value in your careers as investors?
Listen to other people's opinions.
I think it's hard when you say one. That's what makes it hard. What I'm trying when I fall in love with a company, it's because there's something unique about it. They have found. I'm looking for markets, by the way. Bruce used to say that they're looking for markets, not technologies. But very often with new technology, you open up markets. And when a company develops an innovation that opens up a new market, that intrigues me. And that's because that creates such a huge opportunity if you do it right. And then and that's when it's fun to deploy your set of skills and your experience. And if you can build a team around that opportunity and they can execute well, it's such a reward.
Yeah, so I mean, we're generally working with the product market fit stage with these founders, and they're trying to work out, well, who the customer should be and what product can I build and how do I create enough, value for people to change fundamentally what they're doing and then ultimately create new markets from that. Just in thinking about, and so in that, it's a lot about focus and daring. And it actually reminds me of something that I just read. It's actually from Joe Lubin around consensus, and he's talking about Ethereum, but his comment was about OpenAI and Google. And OpenAI was already at that point in time when it could have launched GPT-4 or whatever, pretty big. But it was still, in a sense, finding product market fit, and that was it. And but the comment was, Google was sitting on an enormous quantity of rich AI capabilities and teams, and they'd acquired DeepMind already, which obviously was doing their own incredible things. But it required, OpenAI to be, bold enough to just go and launch a product and create an urgency. Like, we're going to launch it. It's not going to be perfect. People are going to say this is broken in different ways, or they're going to say, oh my God, we shouldn't do this. It's going to lead to Armageddon and Terminator or whatever. But just go do it. And they were the one who did it, and they kind of essentially caught, Google sleeping and so forth. And obviously now Google and Amazon and lots of people are now scrambling to catch up and doing a great job. But OpenAI had that opportunity and took it by a focus on a particular product and that launch that was good enough, but although it was embarrassing in parts or even dangerous for humanity, but going into doing it. So I think that focus and daring and sort of bias to action is what we talk about a lot with the founders.
Look, just want to say thank you both so much for your time today. I've really enjoyed it. I'm sure everyone in the audience has. So I think we have coffee and networking now. But before we go for that, just a big round of applause for Richard and Mons.